She's muted as well. She muted herself.
She did.
I did. Yes, we are.
All right. Good morning, everyone. Thanks for joining. We've got a really cool series that Mike Schoonover and I are going to be doing, basically called What's Going On. And this is the first installment, What's Going On in Lending Today. So I'm your host, Todd Paxton with the Paxton Group, agent over 17 years, small business owner, serial entrepreneur, treasure hunter, lover of all things pro wrestling. So Mike Schoonover with 812 Living Group is going to be working with me here. Mike, just a brief intro to the crowd. I know most people know you, but just a real summary here of you.
Mike Schoonover, been a realtor for 9 years. I'm an investor in all things from stocks to real estate to baseball cards. And
Nice.
Occasionally I write short things on paper and social media.
Love it. So here on the What's Going On series, Mike and I, we strive to bring you relevant, timely info on what's going on in various areas, whether it's industry, whether it's mindset, what's going on. So we talk with the industry experts about their specialty in an effort to bring you real, factual, and timely information to help you to help other people. So good morning, Sean. Good morning, Rachel, everybody. It's kind of interesting. People are just popping up all over my screen, so I'm just going to keep rolling with it. So look out for more Zoom meetings in the future, and this will be recorded. We'll have it on several different YouTube channels, KW, TPG, and other areas. So we'll have this in the future for people that want to listen back. Chris Herrick with Mortgage Management is the VP in retail sales. Brad C., mortgage broker with Kentuckiana Mortgage Group. Thank you, gentlemen, to be our hosts today, our guest today, excuse me. Chris, a brief intro from you, your company, years experience, and something fun about yourself.
All right. Chris Herrick, I think this is my 24th year in the mortgage business, on every side of it, I was a wholesale account rep, management, origination. Company I'm with is eMortgage Management. We are a lender out of Cherry Hills, New Jersey. I kind of run the Kentucky 100 miles into Indiana, 100 miles into Ohio market. And yeah, that's pretty much it. Fun stuff. I love to play golf. That's about it.
Yeah, man. Brad C., what's up with you?
Brad C., I'm the CEO and principal broker of Kentuckiana Mortgage Group. This is year number 2 in business for Kentuckiana Mortgage Group. We just started it back in the fall of 2018. Like Chris, been in the business for not quite as long, 10 years, but kind of bounced around retail lending, correspondent lending before getting into the brokerage world about 4.5 years ago, and been a broker since. Amateur woodworker, love playing golf, huge cards fan. Got a little 3-year-old who's just absolutely adorable, and he keeps me pretty busy.
That's fun. Again, thank you guys for being here today. So this idea to put this on in future events, it started out, over the last couple of weeks, COVID-19 is really, changing the course of business, life, how we do things overall. And we've read a lot of articles as they've come out about, financing, the mortgage rates, the Fed, FHA, VA, all these articles come out. And quite frankly, I'm a farm boy from Charlestown, and it's just taken a lot for me to kind of comprehend this stuff. So this is when we reach out and lean on the shoulders of the giants that have been down the road before us and know what they're doing. So Brad and Chris, thank you. I basically wanted to, in conversations with Mike, we wanted to make sure our teams understood what's going on in the lending world and how does this affect, the pending deals, the new business, down the pipeline, all these things. And then we thought, hey, let's just not keep it a secret amongst our teams. Let's open this up to all of KW. Let's open it up to all of the real estate agents, and then, builders, lenders, other agents across the country. So that's basically the premise of how we got to this point and what we're doing here. So We just really want to have a firm handle on how to deliver this information correctly to our clients. That's the number one goal, because you read things, you fake news, somebody's spin on it, the right, the left, this conspiracy theory, all this information out there. We wanted real factual data. So Brad, Chris, thank you again. Thanks everyone for joining today, spending your time here with us. Our goal is to bring you value today with what's going on in lending amidst what's going on in this world. So let's get going. Brad, I'll start with you. You're kind of left to right on my screen, and then we'll go to Chris. What's going on in lending in spring of 2020? The 80 days of March is now behind us, and we're in April. So what's going on in lending here in spring, Q2, if you will, 2020?
I'm sure Chris and I could probably talk about what's going on in lending for 3 or 4 hours, but I'll try to keep this fairly short and explain why we're in the situation we're in right now. So to keep it kind of simple, servicers collect mortgage payments from everybody that they service, and then they make those payments to investors, the people that are buying mortgage-backed securities. Well, the government said, hey, everybody can qualify for a forbearance because of COVID-19. So the problem with that is, if you don't make your mortgage payment, the servicer still has to pay the investor. So if you just take 1 million people not making their mortgage payment, right? 3.3 million people filed for employment in one day. If 1 million people don't make a mortgage payment at an average $1,000 a month, well, there's $1 billion that servicer is on the hook for. So if all these people stop making their mortgage payments, the servicer is going to be still on the hook for that money. So where that trickles down to us is servicers are no longer willing to buy these mortgages that lenders are funding and closing. So if the lenders can't sell them after the fact, they don't want to fund them, because then they're going to be on the hook for that money if payments aren't collected. So this is all trickled down to us where, and we'll get into this more with some of the further questions down the line, but it's the reason we're in the situation we're in right now with guidelines changing, interest rates all over the place. That's really the source of all of this.
Thank you. That makes sense, because as a real estate agent here in Southern Indiana, working with a buyer or seller and a loan officer, we don't see that really high level understanding. And that explains a lot to me. If there are no investors to buy a loan, nobody's going to give a loan down to the $150,000 loan in Southern Indiana. That totally makes sense. The whole trickle down theory there. Chris, anything to add there?
Yeah, I mean, he hit the nail on the head. I mean, the biggest issue we're seeing right now is, the under 640 market, the under 640 credit score market, because that falls under the Ginnie Mae self-servicing or the servicing platform. And Ginnie Mae is got a clause in there that states exactly what Brad just says. If we are told that the government's going to forbear it, or give forbearance, you still got to pay. Now the hope is coming, and I think a little bit trickled out on Friday, that the government is going to step in and say, hold on, we're going to give some relief to these lenders, which will allow some relief on trickling down to us. And it's starting, to take it a step further, it's starting to affect even higher credit scores with FHA, USDA, and VA market, because the compression, when the mortgage-backed securities are being sold at a high level, there's not a lot of compression. There's a lot of margin so people can make money. Well, that margin is shrunk. So now you're seeing interest rates moving, a quarter to a half a point in a day, just because of this volatility.
Wow. We're gonna dig through. My goal is to dig through a lot of these comments in time. We've got 25, 30 people on this call. Folks, again, thank you. I know we've had some joiners here over the last few minutes. Thank you for joining. You guys have questions, please utilize the chat feature. Mike's gonna, excuse me, Mike's Mike's going to monitor that and just add in. And Mike, of course, you have a good question that comes up, just say, hey, I got a question here from such and such. We've attempted to mute everyone just in the good effort of keeping the four of us, not trying to talk over each other too much. So just utilize that chat feature if you don't mind. So Chris, a lot of volatility. The next question in this, and there's, if I may use the word uncertainty, because that's a word we use in our home. Elijah this morning, he goes, are we really going to have to go use the restroom in the woods and eat from the land and, blah, 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 use leaves for toilet paper? And we're like, I hope not, but I'm not going to, I don't know. There's really a lot of uncertainty out there. What problems are you seeing this uncertainty and volatility? What problems are we seeing and or going to see?
Well, I think that we're going to see. I put something on Facebook last week about number of loans that have been done out of my office over the last 2 years, and then I broke it down to what percentage of those loans were 640 credit scores or under, and it was 29%. That's a big book of business from a small fish. Yep. So you expand that out over the millions of loans that are done every month. That's a big number. So you're losing a big first-time home buyer market is what you're losing, because a lot of the first-time home buyers fall into that category.
Brad, what problems are you seeing with all this, or do you seeing now, and do you expect in the future? Kristen, will you unmute Brad? How'd that happen? There we go. Up.
Well, I muted myself to cough to not interrupt Chris, and I'm not allowed to mute myself after I coughed. So my apologies. So like Chris said, the first-time home buyers that are, we used to be able to, 590 credit score with not a lot of debt, 3.5% down, a couple months in reserves, no issues getting them approved, run findings, approve eligible, and those were going through like a breeze. They're gone, honestly. Like Chris said, we broker, so we've got about 15 different lenders we use. So we're seeing everything from lenders going to 680 plus on FHA to we still have lenders that are doing 600 and above. They're changing daily though. We could get a notice today that those 600s are now 620 or go to 640. A couple have gone extreme. A couple are kind of delayed on changing their guidelines, but they're coming, like I said. And, there's a good chance that anything under 640 is kind of going to be gone for the foreseeable future. I think Chris said this in his first, but, Ginnie Mae's trying to work with these lenders saying, hey, we're going to buy these. We're going to help you service these. We need you to loosen guidelines kind of things. So, but the world we live in right now is 640 plus, and if they got to get a gift, that's an extra layer of risk. If their credit's 641 and debt to income ratio is 41%, and they got to get a gift, that may kill you right there. We just don't know at this point. So the other problems that we're going to run into that I made notes on, Chris said the rates and pricing changing. They're all over the place. One lender is raising their rates by 0.5% as soon as they hit 250 million locked each day. So as soon as they have 250 million locked, rates jump up. So because they're trying to pump the brakes on how much they're actually doing, because they have warehouse lines and they have capacity issues. The other big thing is verification of employment changes. So we're having to get verification of employments in some days on the same day as the closing. So I think for the real estate agents and for the lenders out there, and I'm sure Chris is already doing this, but figuring out, okay, who do we need to talk to? Who's your manager? Who's your supervisor? What's their email address? What's their phone number? What's the best time of day to get a hold of them? So we're prepared to do those verifications of employments an hour before closing in some cases. Closings later in the day give you a better chance of being able to get that verification of employment for closing. And then the other thing that I made a note on is tax transcripts. The IRS is no longer processing tax transcripts, only needed on rural housing loans and some self-employed borrowers. And a lot of lenders, and I can't speak for Chris, but I believe that they do, the client can go out to the irs.gov and get a copy of their tax transcripts and provide that to us for lending. There are some lenders that don't allow the client to get their tax transcripts on their own. So if you got a rural housing deal, that's something to ask.
Yep, for sure.
So you're saying when a certain lender has $250 million of loans on the books in one day, they'll bump the rate because they're concerned. They'll bump the rate by 0.5% on new business for that day because their concern is the investors won't buy it on the back end.
Correct. They're trying to limit their exposure, essentially. So
Okay.
Instead of a lender saying, hey, we're not taking any new loans, they're essentially pricing themselves out of doing loans. So I used the analogy the other day, if you take two gas stations next to each other and one gas station says, we don't want to sell any gas today, and they just raise their price to $25 per gallon, nobody's going to go buy gas there. And that's what the lenders are doing. They're just pricing themselves out of doing the loans instead of saying, we're just not going to do loans.
Yeah, they're controlling the volume. They're controlling their volume in-house by by increasing rates.
And that's not your two respective companies. That's the lenders that you broker to, correct?
Yeah, that's just one of them.
Okay.
That as
Okay. But that's interesting. That is interesting.
Yeah, we're not big enough to we're a lender, but we're not big enough to worry about that big of a number. So
yeah, it'd be a nice problem having two.
Yes, exactly.
Right. Yeah. Right. Chris, what does all this mean? I've got a list of questions breaking down details, but what does all this mean to the consumer out there today, whether they're in Southern Indiana, Louisville, or Baton Rouge, 150, whatever price? What does this mean to them today? Can they get a loan?
Well, I tell you what we're having to do is I started doing this weekend is I have to go back through every one of my pre-approvals over the last 60 days and make sure it's still a valid pre-approval, because there's several of them out there that are not. That are 620 credit scores or 600 credit scores. Those are no longer valid loans. They just so going through those. So I'll be reaching out to realtors, over the next few days and saying, hey, here's my conversations with the client. Here's what we're working on to get their credit score up, but this is where we are. Brad had touched on it earlier. This also there's debt to income ratio overlays now. So you may have a 660 credit score, but now there's some reserve requirements, or at least on our end. It's what our servicers have said, 660 credit score. If you've got a 48% debt to income ratio, we now want to see 3 months reserves. In the government financing world, I hate to say this, but people don't always have reserves. Typically, people who have reserves are probably going conventional because they've shown the ability in their past to save. And people who show the ability to save typically have the money to pay their bills on time, so their credit scores tend to be higher. So that's one avenue or one thing that we're having to work on for future business. Look, I'm on conference calls every daggone day with corporate, and I don't think any of us expect this to be a long-term thing, but I think with the insanity of that rate drop that we all saw a month ago was probably the worst thing that could happen to us. It was great for for Brad and I, because we've got a ton of refis, but it compressed the market such a tight situation, the investors can't buy them, and all of a sudden everything changes, and it's a crap show.
I have a million questions on your statement right here. So we have you and Brad have
Mhm.
pre-approved buyers
Mhm.
that are currently under contract with a closing date of X a few weeks out,
Mhm.
that since all this changed, the credit score requirement has lowered and the DTI have changed. They may not now be able to get a loan to where they could 2 weeks ago, or are they
If
locked in?
if they are, so our take, and this is straight from our CEO, if the loan is already in-house,
Okay.
so it's already gone to underwriting, we are going to look at that loan different than we are going to look at a loan that is not under contract, because of the relationships and the understanding from the top down that we, as the mortgage officers or loan officers, whatever you want to call us, have relationships that we have to maintain. So we have to figure out ways to try to make those loans work. Now, the ones that aren't in-house, yes, it affects them
Okay.
for sure.
Brad, we've got pre-approved buyers that were pre-approved 2 weeks ago. Things have changed. They have a purchase agreement. They've identified a home that they're going to purchase. They've already paid $1,000 or so for home inspections and appraisals. The game has changed, and they're under contract to close in a few weeks or what have you. What do you see in the way you operate?
The same as Chris.
Okay.
If the application's been completed and submitted and registered with the lender, they're going to honor that as far as we know. I don't think that that's a blanket statement that is for Chris and I's business. That may not be true across all lenders that you guys deal with. I have heard some that have completely stopped taking applications, some that are just no longer processing applications altogether, just in some private nationwide Facebook groups that I'm in, and stuff that's happening in other places around the country. Like Chris said, though, if you have somebody that was, so pre-qualifications are generally good for 90 days, in some cases 120. So there could be people that pre-qualified in, beginning of February before any of this happened. So I think for the real estate agents and for you guys, it's important to ask for, we're going to write an offer. I want a new pre-qualification letter with today's date.
100%.
We write offers today, new pre-approval letter with today's date.
Today's date.
No fooling, right? April Fools. So what I heard there, agents, it's all, and we say this a lot, it's all about the relationship. Because if Brad or Chris have a piece of business in the pipeline, they're going to do what it takes to make sure that they do everything they can to get us all happily to the closing table. Is that right? We get hit up a lot of times. Hey, I'd love to do loans for you. We've got relationships, and they're solid. And those relationships in our business and the real estate world mean quite a bit. And I just want to commend you two fellas for being excellent at that. I've known you both for probably almost a decade each. You guys have been excellent with that. Thank you both for that.
Thank you.
So let's break this down here. Are we talking about all loans that are having complications? We have conventional, FHA, VA, USDA are the main ones. And I think we've been talking mostly about the government loans. I'm going to break this down. Are the conventional loans impacted at all, Chris?
With the IRS, the transcripts for sure. We have not seen a whole lot come from Fannie yet. There's talk that something's going to happen. I just don't know. I mean, with a conventional loan, it's so credit driven. And there's so much data. Fannie and Freddie have so much data when it comes to values of homes. And if you can show that you have credit and you can show that you have down payment or some reserves, that's your conventional borrower. That borrower, I don't think is going to have as much restriction. Now there's going to be, like Brad said, there's going to be the transcript issue. There's going to be, rental income issues with using rental income, coming pretty soon with Fannie. It's already happening with FHA and Govy loans. But I don't think you're going to see as much pushback with Fannie and Freddie.
Okay. Brad, anything on that?
No, I agree with Chris. I think conventional deals, are going to be business as usual outside of interest rates not being historically as good as people like them to be. Rates are still good, but they're not, you're not getting 3.5% in most instances. But the 3 and 5% down conventionals are still out there. We're really just educating people on the difference between conventional and FHA. And even though the rate on the conventional may be higher, the likelihood of getting it approved and done may be beneficial. If people are looking to get in houses now, let's get you in, even though the rate may be a little higher than we're comfortable with. And in 6 months to a year, when all this settles down, let's refinance you and get you back down to where you want to be. So
what are we talking there? 4.25 compared to 3.8?
So call it mid fours. I think I priced one out this morning that was 4.5 on a low, kind of a mid-low credit score conventional. So not terrible at the end of the day, but I think what we got to educate people on is the difference between 4 and 4.5% may only be $35 a month, right? So if you got a little bit higher payment for 6-7 months at $35 a month, all in, you're going to be $150 to $200 over the next 6 months total to get you in a house now, and then we'll refinance you when rates and everything kind of calms down.
And honestly, you're locked in. Let's look at it this way. 30 years ago, could you lock in money at 4.5%? I don't know. I don't think so. But you're locked in at 4.5 for the next 30 years, right? Rates go up, down. You're locked in. You know that's what your rate's going to be. Not that you're going to keep it for 30 years, but if you did, you're locked in for that long a time.
We were here 8 months ago. I mean, this is where we're about.
We thought it was great then.
Exactly.
Yeah.
Yeah. So one other thing on that point that I thought of when Brad was talking, the bigger concern for me on the conventional side is PMI.
Okay.
These PMI companies are freaking out because they're the ones that have to insure the money over 80% loan to value. So this is directly going to affect the way they look at things as well. I priced out a PMI, a home ready loan a little bit ago, and the PMI was outrageous.
Wow. Interesting. So agents, hug your cash buyers. I know it doesn't benefit Brad and Chris. Hug your cash buyers. Sellers, consider cash offers with a lot of strength right now. A lot of people say, well, it's all cash at closing. Maybe not.
Right.
Then, second best, hug your conventional clients. Is that right? Sellers, consider a conventional offer with a lot of strength right now. And then let's talk about the others, the FHA, VA, USDA. Not that we get rid of them. Is that what I'm hearing? We still want them as long as they're good and pre-qualified by a strong lender, a solid letter with today's date. We can still navigate the waters with a FHA, VA, USDA buyer. We just need to be very delicate. Is that what I'm hearing?
Right.
And
Proactive. I think being proactive with conversations with the client, lender, everybody involved, and just getting out in front of everything. It's more important now, like get those FHA and VA amendatory clauses back when we ask for them as quickly as possible. Like let's do all the right things up front and be proactive with everything so we don't delay the process any more than it needs to be, so we can get the loans done and funded and closed before anything crazier happens, right?
love that.
Yeah, and something on the Govy side as well. 90%, I'd say 95% of the contracts that we get have seller paid closing cost in it. Mm-hmm. So somehow adding a percent of the loan amount into the seller paid closing cost, you're buying down the rate and getting it back to where, or pretty close to where it could be or where it should be. So there's ways to get us around it, and there's ways to get the borrower where we need them to be. I think the most important thing, and I think this is what you guys do a great job of, and I fight the Baton Rouge guys a lot, is they try to talk loans too much. You guys send them to us and let us do our job. And I think that's a huge thing to do right now, is making sure, like Brad said, making sure the circle of communication is there and that we're all on the same page and pointing everybody in the right direction.
I love it, man. Absolutely. I'll do what I do well, and you do what you do well. Let's not muddy those waters. Right?
Simple world, isn't it?
Simple fact. Simple fact. I want to dig in. There's newer agents, and there's agents like me that I don't understand everything. We've got FHA, VA, and USDA loan. Does the government actually lend that money? Is it the government's money? What does that look like, and what changes are happening? Chris, can you explain that?
Yeah, so upfront funding fees with USDA, FHA, and VA. That's government is they're insuring that loan. They're not funding the loan. The government does not lend for mortgages. They insure the money in order for the servicers to collect the money, and they get paid a premium to do that. So that's the main difference between the government and the Fannie and Freddie loans, where the government does not insure Fannie or Freddie loans.
Say that again. The government does not what?
Insure Fannie or Freddie loans. They insure USDA, FHA, and VA.
So FHA, VA, USDA are different than Freddie and Fannie Mae. Freddie Mac and Fannie Mae.
That's correct.
What kind of loans are Freddie Mac and Fannie Mae?
Conventional.
Thank you.
Mm-hmm.
Got it. Freddie Mac, Fannie Mae are conventional products, not insured by the government, correct?
Mm-hmm.
FHA, VA, and USDA are funded by a lender, insured by the government.
Correct.
Brad, any additions there?
Nope, it's spot on.
Yeah. I wanted to, and honestly, man, it's been so long since I've studied that. I wanted to break that down. Honestly, for myself, hopefully it added value to other people. The government does not loan you money. The government, do they stipulate the interest rate of your loan? When the government lowered the interest rate, Brad, to zero, whatever, we had a lot of agents out there saying, let's get a loan, let's refinance. A lot of lenders, let's go. Educate yourself first. That's not the case. When the government lowers the Fed rate to zero or whatever, does that impact a buyer's interest rate of a loan or refinance? Why or why not?
It does not directly impact it. The Fed rate is the rate that banks get to borrow money from each other from the Fed. It has nothing to do with mortgage-backed securities. In general, mortgage-backed securities follow the 10-year bond. They are not right now for the first time in maybe, I think, history. So at the end of the day, when the Fed dropped rates, everybody freaked out and rates actually went up for a little while, went the opposite way. Like Chris said, there was a couple hours or a day or two there where rates did follow when they dropped, when the bond market dropped. They were locked in a couple refinances, and then just like that, the rates were gone with all this uncertainty and everything going on. So when the Fed says they're doing something, it could impact rates, but it is not a direct relationship.
Not directly, not immediately, not right this afternoon, drop what you're doing and call the lender.
Yeah. The only way that it affects rates is it affects the economy. When you impact the economy, it could have a good positive or a negative impact depending on where mortgage-backed securities are and what everything else is going on in the economy.
Let's stop here. And Chris, you had made mention to one of the, the government did this rate adjustment, and to no fault of their own, they thought they were helping. How is that not necessarily a great thing today and moving forward?
Well, it wasn't the government that did that. So what happened is when the market starts to drop, the confidence of the investors starts to go away. So what they do is they look for a place to make money. So they start investing in the bond market. So you see the market tanking and you see people freaking out, and then you've got all these people jumping into the 10-year bond and trying to buy mortgage-backed securities. Well, what that does is that shrinks the amount of revenue that can be earned on those because there's so much money flooding into that market. So what happened is everybody did that, rates bottomed out, and there's no confidence in the other side of the market. So what do? You can't keep selling mortgage-backed securities because they're not worth anything anymore. So what happens is you see how far did the Dow got down to 18.1 or 18.5, something like that. And there's no confidence anywhere. So what that does is that creates everybody just selling off everything, and there's nobody buying anything. So in order for the markets to have confidence, people have to buy, people have to invest, and they're not doing that.
And we'll have a side conversation about gold and silver right now. People are hoarding it.
Yeah.
It's interesting.
Very rarely do you see bigwigs, investors and stuff come out and say cash is king. It was like 3 weeks ago. One of the big investors came out and said that. So yeah, it's weird. But moving forward, I think that the issue is going to be, where's the consumer the consumer confidence? Or is the Fed truly going to come in? I mean, the Fed came in when they dropped rates to zero. They came in and said, we're also going to buy 200 billion or 200 trillion, 200 billion in mortgage-backed securities. That's less than a month's worth of mortgage-backed securities. That's not enough to turn anything.
It sounds big, but in reality,
sounds big, but it's not much. It's really not much. It's less than a month. So the Fed's got to step in. The Fed's got to jump in and start truly buying a bunch of mortgage-backed securities, and they're starting to, and that will kickstart everything. We thought with the move of the Dow over the last week, that people were going to start jumping back in, but it hasn't happened yet.
Okay. Brad, any additions there?
No, spot on. It's
the
reality that we're living in right now with jobs and unemployment, and it's like you said, uncertainty is driving everything right now.
Yeah, man. USDA loans. One of the popular USDA products is the rural housing loan. People that live in the rural area of Charlestown, all of Charlestown's eligible, some of Sellersburg, a lot of Floyd County, out in the counties, and I don't know the Kentucky maps. Is the USDA loan, is that still a thing? Is the rural housing loan still a thing? And what are we seeing any changes there?
It is still a thing. I think if there's one program that's in jeopardy of not closing, it's probably more so the rural housing than anything. That's not to say you can't get them done. We still have lenders taking locks and rural housing applications. And as far as I know, the team of people in Indianapolis and around the state that are the ones going in and putting the final seal of approval on these rural housing loans are still working from home. So I think the hurdle with rural housing loans right now is rural housing is the only loan type that requires a tax transcript as of right now. So the client has to be able to go on to irs.gov, get a copy of the last 2 years of tax transcripts, and then the lender has to accept them from the client and not directly from the IRS.
Okay. Chris, any thought on that?
Yeah, he's 100% correct, but the other piece is still rate. It's still the government market, so the rates are still. I would love to show, kind of a breakdown of what we're seeing on our end as far as the difference between a 3.5% rate and a 4.5% rate. It wouldn't make sense, so maybe we show it on a sidebar or something like that, without being able to truly explain what it is. So that's the issue you're going to have on USDA as well. But there's a couple questions that can I answer one of those questions?
Yeah, I just want to say you two have both been very good through the years about going through the options for what's best suited for the client. I wish all loan officers did that. Just a compliment to you guys. Do you want to go through the questions there? Go ahead.
Well, I was just going to answer Judy's question. So pre-approval and pre-qualification. I can print out both from my system, call it a pre-approval, call it a pre-qualification. A true pre-approval is an underwritten loan. You're not going to get that. I mean, that if anybody truly, if you're talking about a process to get a truly pre-approved loan especially now in today's world with underwriting times, tightening up, you're talking about a week and a half to be able to get a true pre-approved loan. And that's just it's not feasible. That's not when you guys are out writing a contract, it's our job. Brad and I are both very experienced. We can look at a credit report, we can look at income, we can look at assets and know that we have a qualified borrower. So yes, the terms themselves, pre-qualification and pre-approval, I use them the same way because I know from experience and we know what we're doing. So I have no problem calling it a pre-approval.
Got it. Brad?
Yeah, same thing. Pre-qualification is unverified documentation. Pre-approval is verified documentation.
Makes sense. Another question. Let's go back to the conventional loans. Does all these changes, how do these changes impact a 3% down or a 5% down insured conventional loan? Any changes there you're seeing?
Other than rates being higher and the monthly mortgage insurance, like Chris said, being more expensive, I think it's business as usual. Fannie Mae and Freddie Mac have come out and said if the appraiser can't get into the house, they can do what's basically called a desktop appraisal, where they do an exterior appraisal that, like you see, where home equity line of credits, where they verify data with third parties, do an exterior only of the house, and can submit that for an appraisal. So out the county, as long as county offices and title companies are able to get title, and appraisers are still coming back and we can get the verification of employment, it's kind of business as usual on the conventional side.
Business as usual for the most part on the conventional side.
As usual as it could be, I guess.
Yeah.
We know what's usual nowadays, right? Yeah.
I don't know if Brad, sorry, Todd. I don't know if Brad has seen this yet. He probably will today or tomorrow. FHA is doing the same thing. They are also allowing drive-by appraisals now. So you know what that does is that eliminates all your bad paint jobs on the inside. Your issues that typically get caught from FHA appraisals are not getting caught on the interior.
It also might remove some of the subjectivity of the appraisal, because an appraiser is, I'm not bashing here, an appraiser is a human, and they have certain biases through the years that they might pick up on XYZ, where another appraiser will be like, that's no big deal. So that also might eliminate some of the subjectivity out there that some people give appraisers a bad name for. So not a bad thing, not a good thing. I mean, it is what it is, right? Just to confirm, we've mentioned PMI a couple times. Is it increasing, or what changes are we seeing with PMI specifically? Is it going up? The rate?
I've seen it going up. I haven't seen any changes in, we're a delegated underwriter for PMI, so we don't have to send out, to get approval from the PMI companies. But we feel very confident that the changes, if anything happens with Fannie and Freddie, they are going to run for the hills, just like they did in 2008. Got
it. Brad, anything?
Yeah, I mean, these PMI companies are very scared of people not making their mortgage payments. As a whole, the economy is very, very reliant on. There's a lot of money get paid into mortgage payments every month, right? So if people aren't making those payments and houses go into foreclosure, and all of a sudden these PMI companies are on the hook for a lot of money.
It's interesting, man. And honestly, I think we've sold 1,800 homes through the years I've been an agent, and I just never have comprehended that higher level, like how this all impacts each other, because I'm focused on Clark and Floyd County, Indiana. And this, I've learned a ton today. Thank you both for all this great information. I know you had said, Brad, when I ran into you, it's kind of funny. I ran into you in the real world last week at a closing, and you had mentioned April 15th, things are changing. And of course, that was a week ago. April 15th, things are changing. Credit score minimums are going from X to Y and all this. What's going on with this April 15th date? And then if that is still a thing, and then what credit score minimums are we seeing?
I don't think the April 15th is a hard date. It was just more of things are changing very rapidly, and I don't think it's a hard date anymore because everybody's already started making these changes since we talked, getting out in front of this. So like we talked about, the 640 credit score and above is going to be where most lenders are at, if not higher. I think the important thing to remember is I know you as real estate agents get bombarded with all kinds of emails from different lenders, from retail, correspondent, broker world, things like that. Keep in mind, if a lender says that they can't do something, that doesn't mean that Chris or I can't do it, or that another lender can't do it. If there's something that we can do, like we can't do Indiana housing, right? So somebody else can do Indiana housing. Don't take what one lender says as what they're doing as gospel for all lenders. I think that's the important thing to keep in mind through all of this. As all this information gets disseminated out there and people share things on Facebook and send emails, like one person's truth might not be another person's truth.
Don't kill me when I say this. I always say, you can shop your loan officer, just don't shop your realtor, hire me, right? I mean, our job is to represent our clients for their best interest.
Yep.
And if this lender says they can't, are you going to say, okay, we give up? Or are you going to say, hey, I'm going to scratch and claw a little bit here. Hey, Brad, hey, Chris, is this something you guys could help with? You both are straight shooters and I love you for it. Be like, well, give me a day and I'm going to dig in, or no way, man. They're pulling your leg. Chris just did that on the flip. That we sold, the largest flip we've ever done, and just like, oh, they're pre-approved with some company in Utah. I was like, oh, are they relocating from here? No, they live here. They just found a Utah lender online. I'm like,
Yeah.
Pause. You got to call Chris Herrick, and Chris was like, I want to help them, but not a chance. Like, no. So be cautious, agents, of who you get into relationship with in the lending world. It is a big, big deal here. So I heard the credit. Go ahead.
I was gonna say, for some reason, all the support local for the financial services, people don't think support local. I don't know why. I don't know how we can fix that, but if we can, that'd be awesome.
We fix it grassroots style.
Yeah, I tell you what, with Quicken's in for a world of hurt right now because they're one of the three big Ginnie servicers right now. And Ginnie Mae is taking a bath, so Quicken's going to be Quicken and Loan Depot are going to get hurt.
To that note, they are not allowing locks up front. I'm sure Chris has probably heard that as well. But if they're going to send you a loan estimate that says 3.25 on it and the rate's floated because they can't lock it, and you get within 3 days of closing, like, all right, we got to lock in your rate because we're going to close, and your rate's going to be 5 because they are not held to that loan estimate because it's floated and not locked.
That's correct.
What? Wow, that's big.
The old bait and switch.
Yep.
Go local, go relationship.
Yeah.
I love that, guys. Thank you for that. Even though you're both U of L fans, that's awesome.
My man.
So credit score requirements, what we heard was 640 is now the base. Is that FHA, VA, USDA, conventional, all across the board? Talk to us there.
I still have one lender that's 600 and above. I don't know how long, I can't speak to how long that's going to last, but we still do have a lender, or I think 2 that are 600 and above today.
As of 10 a.m. Yeah.
As of 10:48 a.m.
Right.
On April 1st, we have 1 or 2 lenders still doing 600.
Chris, what are you seeing with the rates, bud?
Well, and that's Govy. So Fannie and Freddie are 620.
Yeah.
They always have it. Yeah, but we have an outlet for Carrington Wholesale says they'll still go down to 500. I'm not going to do the loan. It's you're talking about a 6.5% interest rate with 3 points of buy down. It's just not. And putting down 10%. If you've got a borrower in that situation, They don't want 10%.
Yeah, it's an extreme rare situation, right?
Yeah.
Yeah, okay. So what we're hearing in summary, government loans, FHA, VA, USDA, minimum 640, conventional 620.
Yep.
And every once in a while, extreme rare cases, we might have something different. Contact Chris or Brad and they'll find out.
Yeah. And we're going to let you, I mean, you know, I'm sure Brad's the same way. We're going to let you know up front. I mean, it's a loan or it's not a loan. We're not, you know,
Right.
we're not interested in ruining the relationship we have with you guys to try to squeak out a bad deal.
That's it. So pending deals, going back to that, this could affect some. We just need to dig in a little bit on the current changes. We've got pending transactions with a buyer or a seller having a closing coming up soon. Make sure you get with the loan officer to verify today. Can we still close on April 20th or whatever, right?
Mm-hmm.
And then also keep in mind, agents, that just because the current pending has a cash buyer or a conventional buyer, keep in mind there might be a domino that is dependent on closing in order for this closing to occur. So house A might need to close before your deal closes. Is house A dependent on financing, and has that financing changed? So let's not be so short-sighted of our one closing. Let's look at the dominoes and stack them up there. Is that a fair assessment, guys?
100%.
Yep.
Okay. Interest rates, we kind of covered those. Anything else on interest rates, and what are you guys seeing at 1050 today? So
Go ahead, Brad.
Kind of been, you know, depending on the lender appetite, and if we've hit the 250 million mark with the one lender, honestly, we're just shopping around everybody's rate. You know, one lender may have really good rates one day and raise the next, and one may have bad one day and really good the next. So we're just constantly a moving target. You know, we've switched some clients that are early on in the process to different lenders, increasing our chances of getting approval and getting them better interest rates and pricing. The good thing is we can transfer appraisals, so we're not really delaying the process doing anything like that, which is kind of nice. But rates are perspective again. Rates are still good. They're not what everybody wants them to be at 3% for 30-year fixed. If we get there in 45, 60, 90 days, cool, awesome for everybody. So we'll Chris and I will keep you guys updated on the market, what's happening, and with rates. But now I will say that now is not the time to refinance. I don't think it's still good. Rates are still good, but they're not. Everybody needs to refinance good.
got it. And if you're not friends with Brad C., Chris Herrick on Facebook, friend them up. You guys do both a commendable job about updating. Aside from your atrocious golf game, Chris, you guys do a wonderful job. I've never golfed with you, and I don't golf, so I have no idea if you're good. So you guys do a wonderful job about updating on what's going on in the world with real, factual, and timely information. Great, great job. Mike, let's get you on some Q&A, and then we'll wrap up here.
Yeah, a couple of questions, and I think Brad just touched on it, but refinancing now, is it still a good time, not a good time?
Every situation is different. If you didn't refinance in the previous 7 years and you still have a 6% interest rate, which I actually got a past client in that situation, they just never did anything. Like, for those people, it may be worth looking into, because we don't know that rates are going to tank in 90 days, 120 days, or whatever. So every situation is different. I would say if you bought in the previous 6 months to a year, now is probably not the time. But if anybody's above 5, they should be looking into it. I don't know how many of those are out there, but one thing that, and I'm sure Chris is probably doing the same thing, is I got an Excel spreadsheet of all these people that can potentially take advantage of a refi, not right now, but 60 days from now. And we got a whole list with email addresses and phone numbers, and pretty much telling everybody, let us know if you want to look into this. We'll add you to our list. When the time comes to take advantage of it, we'll reach out.
Mm-hmm. Yeah, totally agree. It's like you said, it's all situational. I mean, the beauty of today's world is values are so high, people can still take advantage, even if the rate's the same. You know, if they bought their house 2 years ago and it was 4.5%, they may be able to get 4.5 again today, but remove the PMI.
Yeah.
So it's all the situation. What I would tell people is don't, this double negative here. Don't not take the initiative or take the time to make the phone call.
Yeah.
It's always worth 10 minutes of the phone call.
Yeah. How about closing time frames? I know, on my deals, conventional, I'm typically looking at 30 days. You go FHA, you might go 35. You go USDA 40. What are we seeing on closing time frames? Are those being impacted?
Go ahead, Brad.
I think they could be. I think in most instances they probably won't be. Like I talked about earlier in the beginning, I think as long as we're proactive in getting things in order and appraisal and title, and people aren't dragging their feet getting us, their 2019 W-2 that they accidentally shredded, we're still doing things in a very timely manner. Underwriting still 2 or 3 days at most lenders right now. So if you factor in 6 days for underwriting, as long as you can get documentation back, appraisal, and title back in a timely manner, I don't think we're going to see any delays. That being said, there could be changes tomorrow that we don't know about today that could cause delays. But I think it's just being prepared for a 30-day. No, you may go back a couple days, and just setting the right expectations with buyers and sellers up front. That the closing date on the contract is and always will be a little bit of a moving target.
Mm-hmm. Yeah, and I think that the hurdles that we have that are out of our control are verifications of employment. We can get the transcripts, have the client get the transcripts, but verifications of employment, thank God the appraisers are now able to do, a little less work on an appraisal, doing a drive-by or a desktop appraisal, it cuts out, travel time of say 35 minutes and then junk time of doing work on the appraisal in the house, 30 minutes. So you're talking an hour savings on every appraisal now. So it's allowing them to take on more work, which is going to help.
Yep. Todd, that's all the questions I have for now.
Got it. Thank you. Anything else, Brad, Chris, that you would like to add that what we expect to come in the future and what agents and lenders and builders, what do we need to be cautious of moving forward this next 90 days of, let's say, quarter 2, 2020?
Go ahead,
I think just educating yourself on the changes and what's happening. Stay out in front of it. Reach out to Chris and I if you have questions about anything or a specific deal. And I think asking the right questions and deeper questions is going to be very important.
Absolutely. Chris?
Yeah, no, it's on, Brad hit the nail on the head. The communication piece is huge. Making sure we're on the same page, and just us making sure we do our job up front. And then also when we get a client from you guys, we're going to take that first step and we're going to get them pre-approved and we're going to tell them what we need. I know I CC all the agents into with the pre-approval letter and what I need. That extra level of accountability from you guys saying, hey, got the pre-approval, make sure you jump on it. Especially if they want to run out and write an offer right away. If it's a tight deal, it could change. And things are changing daily. So we want to make sure that we address everything in a timely manner as fast as we can.
Hey, Todd, real quick, I'll make a point. Just like information about the virus is fluid and maybe incorrect depending on the source that you go to. Following both Brad and Chris on Facebook, social media, they have been very good about putting true, accurate, and correct information out in a timely manner. So the information that you get is the source is just as important. So follow those guys on social media and they'll be your friend.
Absolutely. And Mike and I have done a ton of business with Brad and Chris through the years. And I will say both of you gentlemen, I've always said I'm the most impatient person on the planet. Then I met Kristen, just kidding. Then I will say you two guys, I like rolling with impatient people that get things done and take action. You two gentlemen are very good about that. And you use the word proactive. Stay ahead of this. Stay ahead of XYZ. Let's predict what could come down the pike as a hurdle. You two men are excellent at that in your lending practice, and I just commend you for that. So it's about the relationships. It's about communication. Keep your business local with these two gentlemen. The world is not ending. Not everyone is losing their job. Today, in the past 24 hours, I believe it was 15 houses just in southern Indiana went under contract. That means that 30, with the buyer side and the seller side, that means 30 real estate agents are earning a commission coming up, as long as they all close. But there's business being written every single day. In 2008, and it was either 08 or 010, our worst year in Syra, only 10 houses closed every day. We're seeing still 20 to 25 close every single day, guys. Ladies and gentlemen, it's still moving. The world's not ending. This will all pass in time. It's up to us to shed the light on what's going on with people out there, our clients, our team agents, our coworkers. And I just want to thank you, Brad C. with Kentuckiana Mortgage Group, Chris Herrick with Mortgage Management. You guys are just top notch. Thank you for being on the call. Ladies and gentlemen, just follow them on social. And if you guys have any questions, they're just no Brett, no cards, whatever. Anyway, just want to say thank you all for being on this call. And we'll have this in a recording for your coworkers if you guys want to review it. Thanks so much, Cal.
Thanks, everybody.
Take care.
See you guys.